Do you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Hello, everybody. This is Harold Green of Bright Tree Wealth Management, and it's time to stop doing what you hate. Hopefully, you folks are having a fantastic day. I'm doing pretty good. It's the weekend for me, and pretty excited to be bringing today's podcast to you, as I always am. And, a lot of times sometimes I have a really hard time of trying to figure out what to talk about, because there's just so much to share and so many things to talk to you folks about. The information well is endless, right? And sometimes we just get bombarded with information overload. But today I want to share something with you, a little bit of insight that I've received, some, I would say some intellect, through some trial and error and different things like that. And so I just want to share that with you. But before I get into today's show, I want to talk to you a little bit about my week. It was a holiday weekend. Really didn't get a chance to take a lot of time off because the holidays fell over the weekday and not necessarily a weekend per se. And so it was just you got the one day off and then it was back at it again. But on the market day, when the market is closed, I actually was doing other stuff, getting prepared for the next day. And it's interesting. You learn a lot of stuff when you take a couple of minutes and you take time out and you just kind of look back on things and look back on where you've come from and then what you've been able to accomplish. And so today I want to get into a little bit of a podcast on our option strategy and how we've used options in our clients' portfolios to generate some pretty interesting returns, to say the least. But today it is a investment show, and investments do carry risk of loss, and past performance is no indicator of future results. And before you do any investing, you have to understand your risk tolerance and your time horizons and make sure that your investment strategy is part of a well-balanced, comprehensive financial plan that includes your goals and risk and different things like that. And make sure you really understand what you're doing. And I don't want you acting on anything that I share in today's show. It's for informational purposes only. And so, if you're a do-it-yourselfer, go do your own research and make sure you know what you're doing before you start acting on things, because it can be very detrimental to your financial success. And there's a lot of know-it-alls out there, and people who think they know everything, people who think they're super smart and super genius. And there are some people, but when you're fidgeting and fumbling with your own portfolios and you're guessing and gambling, that's a very dangerous situation. And you have to take very calculated risk, but you have to have your research done. And I want to talk to you about a strategy, an options overlay strategy that can be used in a portfolio to generate some pretty radical returns. That's no guarantee. And there's no guarantee on that at all. It's purely speculation. Some of it is pure speculation, but a lot of it's based on fundamental analysis, technical analysis, and different things like that. So I want to get into call options first of all, and you can go do this research on your own. And if you're a client, this is very important that a lot of my clients, they trust me. They know what we're doing. They have the risk tolerance for it, but they don't really understand the nuances of it and how critical it is to make sure you got your timing down. And option strategies are for an active managed portfolio and not a buy and hold portfolio. And, I say that because if you're in a buy and hold portfolio and you're not really watching it, you're letting it go up and down, options will destroy you. Because if you don't get in at the right time and get out the right time, you can lose 100% of that options trade that you made. 100%. Either you bought the option too close to the expiration date and the stock tanked, or you bought the option too far out and you didn't exercise the option or cash it in and it expired and you just lose the whole entire thing. And that's why a lot of people say options are dangerous. Yes, riding a motorcycle is dangerous too, but you got to know what you're doing. And the problem is there's a lot of people who really don't know what they're doing. So I want to get into this and just kind of give you an idea of what this takes. So are you ready? 1, 2, 3, let's get it. And we want to look at call options, and call options are very simple, very simple. And what you are doing is you're setting the price that you are willing to pay for a particular stock on or before a certain date. And I want to take a look at an option on Supermicro Computer. And as you know, they've been beaten down real bad. There's been a lot of negativity on it. And so, how would you play something like that? And because there's a lot of unknowns in terms of what actually led to them getting beaten down inside of their accounting, there was, some sort of misrepresentation or whatever it might be. And the story is still not clear yet. It's a he said, she said. There's been no smoking gun, but the market has punished the stock just based on the information that has come to light with the auditors resigning. The market took that as a red flag. And sometimes auditors could resign for a variety of different reasons. And sometimes it's good, sometimes it's bad, sometimes it's not bad, sometimes there's a conflict of interest, sometimes there's, a conflict of ideas or whatever it might be. It's a variety of different reasons. And so we've had auditors look at our firm. And when we were registered in the state of Hawaii, we had auditors. We had to pay for auditors every single year to generate a report that showed no fraud in our company. Because when you're managing people's money, there can't be fraud. There can't be fraud in my firm and my accounting books, and there can't be any fraud in how we do our billing to our clients. All of that stuff has to be extremely transparent. And so, not sure what the case was with Supermicro, but again, with something like this, and I'll kind of get into what I want to talk to you about in a second, but I just want to give you the background on what options are. Just real simple, basic call options, not spreads, verticals, butterflies, none of that crazy stuff, because I think people make it way too complicated and they try to limit the downside too much and maximize the upside too much and try to protect the middle too much. It's just not, if you're a genius, you can probably pull that off, but it's complicated. And so we try to keep it very simple in our firm. And of course, this is for clients who have a variety of different risk levels. And so the higher the risk level the client can take, the more options we do put in their portfolio. And so when I want to maximize a direction on a super micro, if I think that the stock is going to recover and take off within the next 2 years, I'm going to buy a certain contract on it. So I'll give you an example. If I think super micro is going to be worth, anywhere north of $100 or more within the next 2 years or so, I'm probably going to go in and buy a $25, $30, $40 call option, and sometimes like an $80 call option. It kind of depends on where the targets are, the trends, and what the stock has been trading at. So I'll have a range of options that I would probably want to buy. So personally, what I did is when Supermicro got hammered, I went and I bought a $3 call option on Supermicro last year. And I probably had it for about maybe 2 months, if that. And it was the Supermicro January 16th, 2026, $3 strike price call option. And what that means is on or before January 16th, 2026, I get to buy Supermicro at $3 a share, regardless of what it's trading at. So if Supermicro goes up to $200 a share, I get to buy it at $3 a share. And then I can sell that back to the market, or I can hold it for the long term. It just kind of depends on my feeling on the company and what they're doing. More times than not, I won't exercise the option. I hardly ever exercise options. I simply sell them back to the market and I take my profit on the option. And right now, I am up in the last couple of months on that trade 47%. No, that's the positive side. But before Supermicro got in trouble, they were rocketing to the moon, and I bought an $82 call option, and I'm down 68% in that option. But I have until January 16th, 2026 to try to turn a profit on that call option. And I'm down pretty big in it. And so that's just one position that I have in my portfolio and in some of my clients' portfolios, but I'm not too deep into the numbers in their portfolios because they have a different level of risk. So we could be down the same percentage, but I could have bought $20,000 of call options in that client's portfolio, and they could be worth $1 million, $2 million in that portfolio. It just depends. But that's the negative side of the call options. Okay. But the positive side is if they do turn it around and that stock does take off, we're going to make a lot of money on it. And so before they got in trouble for whatever it is that they're dealing with, none of this was a conversation at all. The stock was flying. It was doing really well. But any trade that's made after I find out about anything that's going on with that company and drives it down, any kind of potential return in the future is going to be purely speculative, right? And here's why I say it's purely speculative. If you're doing a fundamental analysis on the company and their accounting is all weird and you don't really know what it is, you're speculating that it's okay. Now, when is it okay to speculate and when is it not okay to speculate? And one of the things that we do is we have access to software that tells us insider trading, institutional holdings, basically who's dumping the stock, who's buying the stock, and so on and so forth. And so when I pull up the software, if I see firms, large firms like a Fidelity or a Vanguard, if I see them not dumping the shares, but picking up shares quarter over quarter, even in the light of this negative news, that kind of tells me something right there. That tells me something. And so when I look at the chart from Q3 to Q4, at this moment, I basically see BlackRock picked up 4 million shares. Susquehanna, I guess that's how you say it. Susquehanna, they picked up 29 million shares and they've been picking up shares all year. It's just insane. I don't think everybody's quite reported yet, but I'll see at the end of January who picked up more, who didn't pick up more. But when I see BlackRock picking up 4 million shares, they must know something, right? And it's on their Form 13G, I believe it is, or whatnot, or whatever the form they fill out to say what their holdings are. So to me, I think that speculating on this and taking a position in it, it's extremely risky. But when you have data to back up your assumption and why you should be buying or not buying a option on a position, that's very important. Now, puts are the exact opposite of call options. And so put gives you the right to sell a stock at a specific price on or before a specific date. All right. So if I were owning the shares of SMC outright and I bought a put option, say for at the time $500 a share within 2 years, and say Supermicro went down to $15 a share, I still have the right to sell the stock to the market at $500 a share, regardless of how low Supermicro is trading at, because that was the contract that I purchased. So basically, options can work for you or they can work against you. And so the question is, all right, when and how do I use options in a portfolio? That's very important. And one of the things I look at is whether or not I'm speculating or am I trying to capitalize on a particular trend. And normally when I use options in a client's portfolio, it's normally because the market has turned fearful or the market has turned greedy, the market has turned complacent, or the market has turned doubtful or biased. And I'll give you some quick examples of a couple of these. So a lot of times I'll be watching the fear and greed indexes and see what the market is doing overall. And when the market is extremely fearful or it's in a fear-based situation, I'll look at a couple of different things. Number one, has the underlying trend changed? Okay. If the trend hasn't changed, I'm trying to find a reason for the fear. Okay. Sometimes the fear is algorithm generated with people taking profits and selling with low volume in the market. When there's low volume in the market, the selling gets exacerbated to the downside because a lot of times if there's low volume, it's mostly selling and selling is bad apparently. And so the algorithms continue to sell and this drives the market down. So over the holidays, that's exactly what we had going into the end of 2024 into the beginning of 2025. We had low volume. People were on vacation. Nobody was trading except people taking profits, rebalancing portfolios, doing tax loss harvesting, whatever it might be. And you had to wonder when certain positions got beaten down really bad. You're talking 5, 10, 15, 20% pullbacks here. Just in a matter of a week or two, it made you scratch your head and say, what the heck are these people doing? Why are they selling now? They must have so much profit that they just want to take it and run. Who knows why, but it drove the market into a fear-based situation. And so I was talking to a client, he's like, yeah, I hope you're getting some time off. And I was like, not really, because no, right now is the time we're buying. We're in here real hard buying right now. repositioning some cash, buying up these options on these stocks that people are just leaving for dead because they don't want to touch it right now because they're not sure on the other side of the new year what the stock is going to do, whether it's going to go up or whether it's going to go down some more. So they became fearful and they just, to me, they became complacent. And so we bought while everybody else was selling. Some people say, well, that's a stupid idea. Why would you be doing that? The market is telling you it's not good. My question is this: if the fundamentals haven't changed and the trend and the theme hasn't changed, why would you follow along with what you see going on in the market and become fearful? You're just playing into the hands of the ones who have the insight, the intellectual insight and discernment to know when to buy and sell. And if you don't have that, that's why it's important to have somebody managing it for you. And that's what my clients allow me to do. Now, when the market becomes complacent, I'll look at positions that I think the market is becoming complacent in, whether it's trading within a range. And I'll give you an example. Microsoft has been range bound for about a year or so. I mean, in terms of up and down, they haven't done that well. And there's been heavy selling in Microsoft or options in Microsoft. Some of them have done well. Some have taken a beating because they've been range bound. And if you buy an option and the stock is trading within a range and it's not moving, that's not a good sign. So you have to ask yourself a couple of different things. What has made this stock become range bound where it's not breaking out? When is it going to break out? How powerful is that breakout going to be? And what kind of momentum is behind it to continue to drive it, right? And that's what I'm looking at here. So Microsoft is one of those positions where we got enough of it. We have enough of the options in Microsoft. We have expiration dates in 2025, I believe 2026, and then expiration dates in 2027 on our Microsoft options. And I believe the theme over the next 2 to 3 years is going to be software based because once you get all your chips and your data centers in place, then you're really going to be trying to turn a profit on your AI models and the machine learning. And hopefully in the next 2 to 3 years, that's going to be showing up in the bottom lines because if it does not, a lot of these software stocks are going to crumble because they couldn't figure out how to take the capital expenditures that they put into AI and turn it into a profit. And so that to me is a trend. And the question is no matter what, which companies over the next 10 years are going to do a great job of implementing AI into their business model and be able to turn a profit relatively quickly? And you're going to have to be on the lookout for that because that's the next generational wealth creator right there. And so if you understand a trend, whether it's to the upside or to the downside, then I think you could do quite well with adding options in the portfolio. But you're going to have to watch it. You're going to have to understand the potential target prices, any type of volatility that's going to happen with that option. You have to understand that. And so there's a lot of different risk involved. And there's the risk of them missing earnings that can kill your options. There's a risk of DOJ investigations. There's a risk of China. There's a risk of war. There's a risk of interest rates. There's a lot of different risks. But if you can carefully navigate that and then have these options in your portfolio to boost the potential to the upside or make money when there's a potential to the downside, I think you'll do well. The dangerous part is trying to play both sides and trying to, I guess, leverage both sides to the up and to the down. And sometimes you can say, all right, I'm going to get into the call option, but I'm going to put a stop loss on it so I don't lose a lot. I'm going to buy a put option on another stock and I'm going to put a stop loss on it so I don't lose too much. Sometimes you can get stopped out on the way down or get stopped out. Say you have an NVIDIA option and you say, hey, I don't want to lose no more than 20%. And you put a stop loss of 20% on it. Say it goes 21 down 21%. And as soon as it hits that 20% and it's going to go down further, it automatically stops you out. But what if it goes down 5 more percent and then within the next month, it goes up 30%? What did you just do to yourself? And so sometimes that's why being in active management, you have to understand, is this a temporary pullback? What's causing the pullback? And should I be adding on this weakness? And so I do a lot of adding on weakness when I see weakness in a certain position and I know why it's weak. If it's not a fundamental issue or an earnings report issue, then I know it's more of a fear-based situation or a narrative that they're trying to push out there in the market. And so the other thing I want to talk about is, again, anyone can use an options overlay strategy in their portfolio, whether they are conservative, moderate, aggressive. What's going to determine how much options or how many options and at what price goes into the client's portfolio is their level of risk. I'll give you an example. You can have all fixed securities in your portfolio. You can have basically, I would say 90% of your portfolio can be fixed securities and, fixed income, different things like that, treasuries. And the other 10% can be options on technology. That's kind of like you're playing both sides. And let's just say you have $1 million and 900,000 is in fixed income securities, treasuries, bonds, and things like that. The other 10%, which is 100,000, are in options on technology. The question is you just have to figure out which options on which technology stocks and then kind of go from there. And that's what can be done for conservative clients. But my clients that are full on risk, like say a risk score of 0 to 99, and them being a 99 or a 89 or somewhere around there, they could have $500,000 in their portfolio in options. In $1 million portfolio, it can be 50-50 options, and it can be 50-50 options and stocks. It just depends on the risk tolerance. I have some clients that are 100% options in their portfolios, and that can be in a Roth IRA. And because for some clients, I believe that the most riskiest portfolio for them ought to be the Roth IRA, because the riskier the portfolio, the greater potential return that they can gain on that Roth IRA. For example, if you have a $20,000 Roth IRA and you're in the situation where if you lost the entire 20 grand, it wouldn't matter to you because it's just not going to be a big part of your overall retirement plan. Then we can go ahead and max out that, because I've had some situations where that $20,000 turned into $300,000 just in a matter of a couple of years or close to it. Just because we picked up the right option at the right time and we just rode it through the volatility. And I would say that's becoming a more and more, it's not a guaranteed occurrence. It's becoming more of a normal thing that I see in certain times, but you also have to know when to pull back and when to cash in those options. And so, if you're in an IRA, it's a little bit easier to do because you don't have to worry about the capital gains being short-term, long-term, no matter what it be. But if you're in a non-IRA account, it's sometimes it's very volatile because you can't get out and wait till it go down and then get back in again because you have the capital gain situation that you're watching. And so I just wanted to give you a snapshot and overview into how we use options in our overall rapid retire financial planning process. And if you're a client, hopefully this is helping you understand the process a lot more. If you are looking at becoming a client, this is a very important show to understand how we use this strategy to help potentially grow your monies in a different way than what you've normally seen. So if you want to know more about it, get on my schedule, call Beverly 808-521-4401, and we'll see if you have the appropriate risk tolerance to have something like this in your portfolio. We do have minimums of $500,000. I rarely waive those minimums just because for a lot of different reasons, but we just have to be careful who we work with, how we work with them, and just to make sure that they are a great fit for our strategy overall and that our strategy is a great fit for them and their goals. And so thank you very much for listening to the show. Our telephone number is 808-521-4401. You can also find us on the website. Shoot us an email or whatever it might be, get on the schedule, and we'll see if we can make something fantastic happen for you. And until next time, everybody, 1, 2, 3, let's get it.
This is thepodcastfactory.com.